Yes, welcome to our third question. We are moving to question 3 of our paper on financial accounting that was done by the KASNEB students, CPA students, December 2024. Now, the third question, let's start from the first part. The first part is asking, highlight 4 roles of accounting standards. Highlight 4 roles of accounting standards. Basically, when we talk about accounting standards are a set of rules that guide accountants or accounting professionals in terms of how they're supposed to record their financial statements in an organization. So you'll find that the accounting professionals or accountants have to follow these. It prescribes specific formats, features, and how to record the data within the agreed, basically within the agreed standards. And now you'll find that these standards cut across. There are those standards that basically they are being applied in different countries. Same standards applied based on what type of standards that are being used, and you'll find basically the overall view in terms of how accounting professionals should always report or indicate data whenever they are preparing the accounting or any financial statements. So as we have said that the accounting standards is a set of rules and guidelines issued by recognized bodies that companies and organizations must follow when preparing and presenting the financial statements. So these standards ensure that financial reports are consistent, they're transparent, and they are comparable across different business and periods. So for example, I have given the examples of the accounting standards. For example, we have the International Financial Reporting Standards, known as the IFRS. These are used by many countries worldwide to standardize financial reporting in different organizations. We have the General Accepted Accounting Principles, the GAAP. These are used mainly in the United States. And then we have the Local Accounting Standards, whereby many countries have their own accounting standards aligned with the international norms that basically are used. So when it comes to the key roles of accounting standards, first is to ensure consistency and comparability. In terms of when you talk about this, the aspect or the role of consistency, it means that we need to ensure that we have a clear one format that should be used when reporting financial reporting throughout different periods. So that we can be able to have a common way of analyzing and reading these financial statements. So when you talk about consistency and comparability, we are talking about that accounting standards play a very crucial role in ensuring consistency in the preparation and presentation of financial statements. So by establishing uniform rules and guidelines and principles for recording these financial transactions, they allow stakeholders to make meaningful comparison between different companies across various time period. So when we are talking about that, we are preparing financial statements based on specific guidelines that have been recognized internationally. It makes it easier for companies to do comparisons in terms of their performance with other companies, maybe within the same industry. Also, it makes it easier for all these comparisons to be done in different periods, if you look at different periods and all that. At the same time, it makes it easier even for the organization itself to do comparison among itself in relation to performance within different periods. Let's say, for example, for the last 10 years and stuff like that. So for instance, if both Apple and Samsung apply the same accounting standards, their financial performance can be fairly be compared, which means that they are reporting the same thing. It becomes easier for you to tell which company is making more profits than the other, which is financially stable than the other, and stuff like that. So similarly, an investor can assess how single a company performed in 2023 versus 2024 without worrying about the changes in accounting methods distorting the figures. So you are able to do comparison within different periods within an organization itself. So this consistency helps eliminate ambiguity in terms of confusion and all that, and subjectivity, and at the same time it helps making financial analysis to be more accurate and of course to be more useful. Number 2, it enhances transparency and reliability. In other words, the financial or the standards that are being given by the different bodies or recognized bodies, they help in ensuring that transparency, in other words, all the information that have been used, all the information that has been used in transaction is put clear or is made clear, and at the same time you can rely on such kind of document because there's an assurity that the documents have captured all the information in the way that information needs to be captured. So transparency is a very vital in financial reporting. So, and the accounting standards will help or does help achieve it by requiring full and honesty disclosure of all material financial information. So this includes details such as contingent liabilities. From the question, I think the first question above, we discussed about the contingent liabilities, related party transactions, and off-balance sheet obligations, which might otherwise be hidden in some time. So by mandating standardized practices such as the IFRS or even the GAAP that is used in the United States, accounting standard minimizes the risk of manipulation through through creative accounting techniques. So as a result, financial statements become more reliable and offering users a true and fair view of the company's financial performance or position within a given institution or within a given space. Thirdly is that it facilitates regulatory compliance. So accounting standards provide a structured framework that supports the organization in meeting various legal and regulatory requirements. So in other words, when you are preparing financial statements based or following the specific accounting standards that are given there, it's very crucial even for the government to determine how much tax you are supposed to pay from the profits that you are earning, from the profits that you are earning. And for you to determine the profit that you are earning, it means that you have to then prepare these financial statements correctly, neatly, and ensure that all the information is captured to be able to give the real figures in terms of how much really you are making. And then that determines how much you're going to pay in terms of taxes. So governments, tax authorities, and corporate regulators often require companies to prepare financial statement in accordance with recognized accounting principles. This ensures that companies comply with laws such as Companies Act or taxation regulation. Furthermore, these standards align closely with audit practices, e.g. like the international standards on auditing, enabling auditors to effectively examine and verify the accuracy and integrity of financial statements. So the link strengthens the trust in the corporate reporting process. Fourthly, it helps to boost investor confidence. Sorry. When companies follow established accounting standards, it signals to investors and creditors that the financial information provided is credible and trustworthy. So it makes the investors to have confidence in such kind of institution. It makes these investors to make the right and informed decision whether to put in money or even to withdraw their money based on the recorded information. Some companies, we have experienced where some companies do not report the true figures of their financial performance. So they cook figures, they report false information so that they can have investors keep investing their money because of the restaurant. But now when it happens, you realize that there was a time, like for example, you could find that I remember the Prime Cabinet Secretary, there was a time he called upon SACCOs, whereby SACCOs were using loans to pay dividends. Doesn't make sense. Whereas dividends are supposed to be paid from the profits that the organization make. So when you are, when you are trying to, like, you are borrowing loans to pay dividend, it means that you are lying to investors and other stakeholders that you are financially stable, you are performing, while you are not, so that they will keep on investing in this company and all that. But at the end of the day, that does not reflect the true picture of your financial performance. So when we report based on the standards, so standardized reporting reduces the information asymmetry by ensuring that all users of financial statements have access to the true, clear, comparable, and unbiased data. So this transparency allows investors to make informed decisions regarding their capital allocation. And for example, under the IFRS 15, companies are required to follow strict revenue recognition rules, which prevents inflating income and reassures investors about the accuracy of reported earnings. Fifth, it helps to promote accountability and stewardship. Now, when you talk about accounting standards, they also serve as a tool for promoting accountability within an organization, which means that they require management to accurately report how they have used the company resources and whether they have acted in the best interest of the stakeholders or the shareholders and other key stakeholders. So this concept known as stewardship is very vital in corporate governance, whereby standards such as the IS1, which stands for presentation of financial statements, which talks about the presentation of financial statements, ensures that financial reports clearly present the outcome of the management's financial decisions. So this allows stakeholders to evaluate the effectiveness and the integrity of those decisions that were made by those managers. So in other words, they help to have managers being accountable for their decisions that they make, or the executive. Sixth is that it reduces financial fraud and errors. When you are using when you are reporting or you are preparing financial statement based on the guidelines and the procedures that have been provided by these recognized bodies, it means that it creates small room for errors to be made. So in other words, it helps to avoid those errors and fraud, those intentional mistakes that are being or that are likely to be made by the accounting professionals. So strict adherence to accounting standards helps deter fraudulent financial practices and reduces the occurrence of errors. So these standards create clear boundaries for how financial transactions should be recorded and reported, so leaving less room for unethical behavior or accidental misstatements. Like for example, IAS 24 requires for full disclosure of related party transaction, making it harder to conceal improper dealings. So history has shown that the danger of weak financial reporting, like the WorldCom scandal, for instance, involved fraudulent capitalization of expenses to inflated profits, something that strong standards aim to prevent. Second last, our seventh point is in line with supporting economic stability. Now, accurate financial reporting, driven by the robust accounting standards, they contribute to proper economic stability, which means that when companies publish transparent and truthful information or financial information, it prevents the spread of misinformation that could destabilize financial markets. Like, for example, there was a time when these banks, like I think the last bank to be sent to under receivership was Chase Bank. So you see what happens in a situation whereby Chase Bank, the rumors are getting like, oh, Chase Bank is about to be declared bankrupt. So what happened? The next thing is that customers are here trying, everybody wants to withdraw his money and stuff like that. Everybody that doesn't want to get associated with that company and all that. And you see, at the end of the day, the rumors were there from in the morning. By something like 10 or 11, something like there, already the bank had been declared bankrupt, and of course, the account were frozen. No withdrawals, no deposits were accepted at that point. So you find that, for example, IFRS requires financial institutions to report expected credit losses, giving a realistic picture of financial risks. This type of proactive reporting can help avoid major financial disruptions like those seen during the 2008 global financial crisis, which was partially fueled by poor financial disclosures. And lastly, it enables cross-border investment. In other words, in an increasing globalization economy, accounting standards like IFRS facilitate cross-border investment by ensuring that financial statements are understandable and comparable across different countries, which means that investors from different countries will have no problem getting to access of the accounting, or financial statements from another country, going through the financial statements, understanding them, and being able to make the right decisions. So this is especially important for multinational corporations and international investors, as it eliminates the need of restate financial coding to each country's local accounting rules. So for instance, like a German investor analyzes the financial of a Kenyan company can do so confidently if the company reports under IFRS. So this harmonization enhances access to international capital and fosters global business growth in within the region. So it makes it easier for an international investor to invest in your country because he's able to understand the accounting information. So he's able to, have confidence, trust, and of course, he can be able to tell whether the company is financially stable, whether he's making the right decision or not. So that is how you look at question number 1A. Let's move on to question number 2B. Now, number 2B states that, number 3B. The one that we have answered is number 3A. Number 3B states that Roca Limited manufactures high quality shoes. The following are the financial statements of the company during the years ended 31st August 2024 and 31st August 2023. So Roca Limited statement of profit and loss for the year ended 31st August 2024. We have the information there. We have the sales, we have the cost of sales, we have the investment income. We have, of course, you get the sales, you less the cost of sales, you get the cost of goods sold, then you less you less the cost of sale, you get the gross profit, and then after getting the gross profit, you had any other income. So you had the investment income, you get the total net income. So you less the expenses from the distribution cost, administration cost, you get that, you get the total expenses, you less it from the total net profit, you get the net profit. You less it from the total income, you get the net profit before tax and the finance cost. So you less the finance cost, then you will get the net profit before tax, and you less the corporate tax, so which means you are going to get the net profit for the year. Of course, retained earnings brought forward, you add to the net profit of the year, you get the retained earnings carried forward. Then we have the Roca Limited statement of financial position as at that 1st August, both in 2024 and 2023. So the non-current assets, we have the figure there, the accumulated depreciation. We have the current assets in terms of inventory, trade receivables, bank. Then you get the total assets. Then of course you look at the equity and liabilities. We have the capital liabilities there, right? We have the capital liabilities, we have the ordinary share capital, we have the share premium, reservation reserve, retained earnings. Then we have the non-current liabilities, 12% debentures. So then we get the current liabilities, trade payables, corporate tax. Then you have the total capital and liabilities there. In terms of additional information, we are being told that additional information here is that additional information number 1, a company made a profit of 34,320 shillings on the sale of a machine whose cost was 466,986 and whose accumulated depreciation was 102,000 shillings 986. The number 2, the only revaluation made on non-current assets was for freehold land. Required. You are required to prepare a statement of cash flow for the year ended that 1st August in accordance with International Accounting Standards IAS 7. Now, when we talk about IAS 7, basically, IAS 7 deals with cash flow statements. And when you talk about cash flow statements, it states that cash flow should be prepared using, of course, 2 methods. And when you talk about cash flow, this is about money. We are looking at the movement of money between the money that is coming in as cash inflow, then the money that is going out as cash outflow. So sometimes there will be activities, even if you are doing purchases, for example, it means that yes, goods are coming in, but money is going out. So our interest is not on the goods. Our interest is that what is taking money out and what is bringing money in. So according to the IAS 7, cash flow should be prepared using 2 methods. That is direct. You can talk about that is direct method, and of course we have indirect method. Now, when you talk about direct method, direct method is showing the actual cash receipts or payments. In other words, direct cash flow, you take the cash received, then you minus the payments to supplier, or you minus the payments that you made to the suppliers and all that. So in fact, even the IAS 7 encourages for direct method, but practically indirect method is more of the department that is used. Now, when you are preparing the cash statement, or when you are preparing when you are preparing the cash flow statement, basically you will find that there are 3 activities. There are 3 activities that are involved in the preparation of the cash flow statement. One of them is we are going to look at the operating activities. When you talk about the operating activities, these are cash that is generated from the daily operations of the business. These are cash that are generated from the daily operations of the business. And this method from the daily operation business, this is where you can have either direct method or use the indirect method. Then we will talk about the investing activities. We are going to prepare the investing activities. Now when you talk about the investing activities, like this is a situation whereby, for example, it includes the cash flows that are coming from the PPEs. It can refer to when you're acquiring non-current asset, that is it, from the PPEs, we are saying. They help you generate income. And the proceeds of the sale of these activities, or the produce of sale from these investment activities, are what we are going to record here as part of the investing activities. And of course, you can prepare we are going to prepare the cash flow from the financing activities. Now, when you talk about the financing activities, this can include the cash flow from equity and borrowings, like when you redeem your shares, you are able to change your shares and you get cash. It can be when you acquire a loan from when you acquire a loan, you are getting money coming in. When you acquire payment from dividends, you're getting money coming in and all that. So we're looking at those financing activities that help prepare cash. So before we prepare, basically before we prepare the cash, I'll prefer to start by making some adjustments. So we are going to make quite a number of adjustments. We are going to prepare an asset account. An asset account is, we are going to prepare it for the purpose of trying to determine whether there was an asset that was acquired or there was an asset that was disposed. Then of course we are going to prepare the disposal account. The reason for preparing the disposal account, we want to get the cost, the accumulated depreciation. We will want to see if there are sales proceeds, and of course the profit or loss account will be used there. Then of course we will prepare the accumulated depreciation account, where we are going to calculate the depreciation. Of course, you know, you can prepare also the tax payables and all that. So in our adjustments, so we need to prepare these adjustments before we start preparing the cash flow statement. So we will start with the first adjustment. The first adjustment that I've said we are going to prepare is the accumulated depreciation. So it doesn't matter which adjustment you are starting with. You can start from with any, but for me now, let me start with the accumulated depreciation. We will prepare the T account. Just a moment, let me adjust. So we are going to prepare the accumulated depreciation. We'll start with the T account. We can check on the information that we have been given. Now, we have been told from the statement from Roca Limited, the statement of financial position as at that 1st August, we have been told the accumulated depreciation was, we have been given that 7 million. I think this was the one that was carried down, and the one that was 7 million was the one that was carried down, and the 2023 was the one that was brought forward to 2024. So what we'll do, we record the balance, we will credit the balance brought down, and then we are going to credit the balance carried forward. So let me have somewhere where I can record this so that I will not be coming back. So in terms of balance brought forward, we have 6,607,874, and in terms of balance carried down, we have 7,695,142. So we go back to our T account. What we are going to do, I have said that we are going to credit the balance brought forward, and then we will debit the balance. The balance we will, sorry, get it clear. We will credit the balance brought down, and then we will debit the balance carried forward. So for our instance, the balance brought down is we have got it to be 6,607,874, and then credit the balance carried forward, that is 7,695,142. So we'll get that. Now let's see if we are told from the additional information. If you look at the additional information here, we are told that the company made a profit of 34,320 on the sale of a machine whose cost was 466,906, and whose accumulated depreciation was 102,986. So the accumulated depreciation for the disposal is 102,986. So we debit that in our T account. So we indicate it as, we go back to our T account, sorry. We indicate it as disposal. So we have gotten that disposal to be, sorry, I didn't, that was 102,986. 102,986. So we will use that. We will get the balancing figure. In the balancing figure, we will determine whether it was a profit or loss that was made. So we will have here profit or loss. So the balancing figure here is, let me do the calculations. Let me check on my calculator. So we have 7,695,142 plus 102,986. We will get the balancing figure to be 7,798,128. So we are going to have 7,798,128. So for us to determine less the balance brought forward, that was 6,607,874. We will get the profit and loss to be 190,254. So this is the figure we are going to use, of which we have gotten. That will be 1,190,254. Now that is our first adjusting that we are going to make. Number 2, we will make the T account for the tax payable. We'll make the T account for the tax payable. Now, from the information, we have been told that if we go back to the question, where's this information? Yes, from our non-current liabilities. We are getting the tax from non-current liabilities. So from our non-current liabilities, we have been given 674,022 that was on 2023 as the amount that was brought forward. Then the corporate tax in 2024, because that is at December 2024, the corporate tax was 627,250. That was the amount that was carried forward. So what we are going to do, we are going to credit the balance brought forward, and we are going to debit the balance carried forward. So let me just write down the figures. We have 674,024. Then the one carried forward, we have 627,250. So what happens in our payable T account? What we are going to do, we will we'll credit balance brought forward, which is we have said 674,024. Then of course we will credit balance carried down, which is 627, and then 250. That is the balance that was carried forward in the year 2024 as December 2024. Then from the information, if we go back to the information above, look at from the expenses, we are being told after the net profit before tax. Now we are being told that there is a corporate tax, which is 820,924. So what we are going to do in that corporate tax, we are going to credit it, because we are being told that there is the corporate tax was 820. Let me write it down. 820,924. So we will credit that. We will credit that as tax expense will be 820,924. So what we will do here, let's do the calculations. That is 674,024 plus 820,924. You will get, that is 1,494,948. So the balancing figure here is 1,494,948. So after getting that, so we get the balancing figure, that is 1 million minus 627 to 50. You will get, so we have here, we indicate it as cash, we will get 867,698. So that is the balancing figure at that point, 867,698. Now we move to the third account, the disposal of a machine, because we are being told one machine was disposed. We are being given here in additional information that the company made profit of that 4,320 on a sale of a machine whose cost was 466,986 and the whose accumulated depreciation was 102. So we prepare that adjustment account for the disposal of machine. So in according to the procedure, when you indicate, according to the historical cost concept, when you indicate the cost of the machine, you indicate when you're indicating the cost of the machine, we indicate the cost at which the machine was purchased. So the cost at which the machine was purchased is 466,986. So we debit the cost at the machine that was purchased, 466,986. So we put here cost of asset, that is that was 466,986. Then now definitely we were told that the machine accumulated, so we are being given that, and whose accumulated depreciation was 102,986. So accumulated depreciation will be credited, that is 102. Just a minute, I want to be clear. That is 102,986. And then we are being told, from that information, we are being told that the company made a profit of that 4,320. So here we are being told we have the cost of the machine, we have the depreciation amount, we have the profit that was purchased. We have not been given the proceeds, the sales proceeds for this machine. Majorly, in many instances, we are given the proceeds and we are either asked to calculate maybe the profit or the loss. But here now we have been given the profit and we haven't been given the sales proceed for the machine. So what we are going to do, we will debit the profit, so that 4,320. So we will debit profit, which we have said that is that 4,320. So this will help us get the cash or the cost or the sales proceed of that machine. So here let's add this. Okay, that is 466,986 plus 34,320. That will give us 501,306. So 501,306. So if you less 501,306 minus 102,986, you'll get 398. So here we put as cash, which is which was 398 320. So this cash is basically in other words is the sales proceed, which means that if that machine was purchased at the cost of 466, it had depreciated by 102,986, and it was sold at 398 320, and the owner was managed to get the profits of 34,000. So basically, in other words, what that means is that the sales proceed, or what the machine that was sold, it probably was sold at 398. That is our interpretation. So the next thing, we'll go to the non-current assets. Let's make the non-current asset account. Now, in non-current asset account, from our information, definitely from the non-current asset, we are being told that we have a in the non-current asset, we have a machine that is depreciating, and its cost is 466,986. So we are going to credit that. At the same time, we are being told that the only revaluation made on non-current asset was for freehold land. So if we look at the non-current assets, we have the accumulate. We have the balance brought forward is 27,8. The balance brought forward is 27,833,208. We are going to debit this, and then of course we are going to have the revaluation of land from our we are going to get that information. Let me just have the information down. First, the balance brought forward for non-current assets is 27,833,208. Okay. Then of course we have said the cost for the machine that depreciated, cost of machine was 466,986. Okay. Then from this information here, we are being told the net is it the net profit? No. Okay. So we prepare. So we have the non-current assets. So we come and we in the non-current assets, from the information as we have said, we have been given a machine, a non-current asset, a machine that was sold. The cost of that machine was 466,986, and of course we are being told in the non-current assets here, we are being told that the balance brought forward was 27,883. I think I've recorded that. The balance carried forward was 33,930 and all that. So we debit the balance brought forward, then we credit the balance carried forward. Then of course from the additional information, we have been told that the only revaluation made on non-current asset was the freehold land. So if you look at here on the equity, we have been given the revaluation reserve. So what you're going to do here, let me just indicate here, we are going to look at that revaluation reserve. That is 3,876,080 minus, because it has revaluated from the year 2023 to the year 2024. So we want to get by how much? So minus 2,127,840. So if you get that, you will get the amount for revaluation for the land is 1,748,240. So this amount we are going to debit it also. So we'll come back to our non-current asset. So we check on disposal. We credit the disposal on machine. So the disposal on machine, we always say that when we record the cost, you record the machine at the cost. So we record 466,986. Then of course we have said that the balance brought forward, we debit it. That is 27. I recorded it at 27. 27,833,208. Then now we credit the balance carried forward, which is 33,930,000, of course 702. Now on we debit the revaluation of land. Now revaluation of land, we debit the figure that we have got, that we calculated. This figure that we calculated here, we got it at 1,748,240. So we debit that figure also. That is 1,748,240. So if we look at the balancing figure, let me check on that. So if we add 466,986 plus 33,930 plus 930,702, we will get 34,397,702. Get that 4,397,000. Sorry. We'll get that 4,397,688. So here we get that 4,397,688. So let's check on, so that we can get the balancing figure. So that 4,397,698 minus 27,833,208 minus 1,748,240, you will get the balancing figure to be 4,816,240. So this becomes our cash. So this becomes the balancing figure. And lastly, because now we have been told the land was revaluated, we prepared the revaluation reserve for that land. So the revaluation reserve. So we will start by, of course, we have been given from the information here, we have been given the revaluation reserve. The balance brought down was 2,127,840, and the balance that was carried forward was 3,876,082. So what we do, we debit the balance carried down. The balance brought down, which is 3,876,820. Then of course we are going to credit the balance carried down at the balance brought down, right? Let me not let's remove the confusion. What we are going to do, just get it correct, we are going to credit the balance brought down, that is 2,127,840, and then we debit the balance carried forward, that is 3,876,080. So in that revaluation land, we have said that we credit balance brought down, that is 2,127,840, and then we credit balance carried down, that was 3,867,080. So we will want to get whether there was a revaluation gain. Of course we calculated that. So what we do, the balance, that is 3,867,080. Then of course 3,867,080. Then of course we get the revaluation gain. We credit it, revaluation gain, that was 1,748,240,000. So basically these are the adjustments that we started with. These are the ones that are going to help us prepare our cash flow statement that we have been requested, because in our second question, not in our second question, yeah, in our the only question that we had here is that prepare the statement of cash flow statement ended that 1st August 2024 in accordance with the International Accounting Standard IAS 7. So basically what we'll do here now, of course, I have taken you through in terms of how you prepare those adjustment accounts. I had already prepared them. We have the adjustments, we have the accumulated depreciation, we have the tax payable, disposal of machine, the non-current asset, and the revaluation. They are clearly indicated here. They are clearly indicated here. Those are the ones that we are going to use. Now, when it comes to preparation of the statement of cash flow, I said that the statement of cash flow is going to be based from 3 activities. Those activities, I said, it's going to be based from the operating activities, the investing activities, and also the financing activities, and I already explained those activities. So what you're going to do is, let's have a cash flow statement. We have been told for the year ended, let me check on that again, for the year ended that 1st August 2024. For the year ended August 2024. Now, so we will have that. Now I've already prepared it, but I'll want us to go step by step so that you are able to understand how we were able to get the data or the figures that we are going to get here. I'm sure I'm going to need this space for continuation. Now let's start from top, and I said we are going to start with the cash flow from operating activities. Now, cash flow from operating activities, we said these are the daily operations activities. So what we are going to do, we will start with the profit before tax. Now, if we will want to go back to our question for us to get the profit before tax, allow me to take this question. Let me just take this question near to the question so that it becomes easier for us to do it. Because I will spending a lot of time going up, down, and stuff like that. So the best thing to do, let me just have this question here. But is it not going to give us a hell of a problem? Let me see what will happen. Okay. No, I think this is good. Yeah, so it becomes easier for us to navigate through. So we have spoken about profit. I'm checking on we were checking on profit before tax. So we come to the question in the data. We get profit, net profit before tax. Net profit before tax is 2 million. Let me indicate it somewhere. 549,404. So our net profit before tax, we will have it as 2,549,404. So what we do, we have had the profit before tax. So when you have profit before tax, In other words, you have received the profit. Just taking a scenario whereby you bought a product at 100 shillings, and then it at 100 shillings, then you ended up selling this. You incurred a cost of 50 shillings in getting that product. That is 150, and then you sold that product at 200 shillings. So the question will be, you have sold the product at 200 shillings, so you have that 200 shillings. Then the question will be, if you remove for example the buying cost, that is 100, you are made with 100, what is the profit? What is the profit? It means that then you have to start removing the transport and all that for you to get the exact profit. So let's talk about adjusted for. So we look at the adjusted for. So basically, we check on from the data here, the information that were from this data, the information we are going to look at from the information, the information, if you look at this data, the information that was listed here, if we go to our cash flow statement, we add them. The one that were added, we are going to list them. So here we have first finance after a profit of before tax, we had finance cost, which was less than that, so we add it there. So we add finance cost, that is 410, 800. Then the next item is going to be the gain on the machine disposed, because we already calculated that from our figure. So we had the gain on disposal of machine, because from the question we were told that the company made a profit of 34,320. So that is the profit, that was the gain basically, and we reported that as profit. If you look at the disposal of machine, we had that as profit, as a profit. So that is that 4 and all that. So what we do, we will less that. So we will put it at gain on disposal of machine. The gain on disposal of machine, we got that will be 34,320. So we less that. I know this question of the cash flow statement, students do not like it, but it's very interesting. Then the next thing to check is if you look at from our data here, we added investment on income. Investment on income, that is 29,484. We will less that. We will less investment on income, that is 29,484. That is the data. So the next thing is depreciation. Now depreciation, because it was less, now we are going to add it. We got our depreciation from our calculations on the T accounts. We calculated on the accumulated depreciation. We got the profit, the balancing figure, the profit and loss, 1,190,254. So that is the figure we are going to add to the adjustment of the profit before tax. So 1,190,254. So we add that. So we indicate that as depreciation. So we add it there, 1 190 254. So if we calculate this, we take the profit before tax, that is 249,404 plus that is 2,549,404 plus 410,800 minus 34,320 minus 29,484 plus 1,190,254. You will get a figure being 4,086,654. So then, after getting that, we move to profit before changing or changing in working capital. So whatever we have gotten, this is what we refer to as profit before changes profit before changes in working capital. This is what we refer to as profit before changes in working capital. So let's look at the changes in working capital. We put change in working capital. Let me just clean my data. Okay. Now, change in working capital. We will start with the increase in profit. Increase in profit. If we go back to our data, we check on the increase in profit. We go back to the question. We have been told that where is that? How do we tell our increase? How do we get our increase in profit? So we are going to get our increase in profit in terms of we are going to less the inventory, the stock that was brought forward, that was 7 million, and the profit that was carried forward, which was 8 million. So if we less the profit that was carried forward from minus the profit that was brought forward, 8,582,288 minus 7,573,696, we are going to get the profit or the increase in profit. So let me just put those figures down so that I don't have to come back. 8,582,288, then we have 7,573,696. So we will come here. Let's do these calculations here. 8, 5, just put them into brackets. 582 288 minus 7,573,696. Sorry, 696. 696, you put into brackets for us to get the increased profit. 8582 288 minus 7573,696 equals, you will get 1,008,592. So you less that. Then the next change in working capital is the decrease in trade receivables. Decrease in trade receivables. So if we can check our trade receivables, we have where are we putting as a decrease? It's because the trade receivables in 2023 were 4,504,864. In 2023, they are 3,231,150. It means that trade receivables are debtors. It means that our debtors were owing us more money in 2023, and they reduced that amount in 2024. What does that mean? That means that money was able to come in. It means that they were able to bring in money in. So we are going to add it. We are not going to less it. We are going to add it. Here in the inventory, for us to get the increase in profit, why did we have to less it? It's because if we were able to increase our stock from 7 million to 8 million, it means that money was used to purchase the stock. So which means that money went out. So we have that. Let me put that 3,231, 150, 4, 504, 864. So we will want to get how much money was reduced. So we can just put that here. That is 4, 504, 864 minus 3,231, 150. So if you do that, okay, let me put that figure here. So if we do that, we get we get 1,273,714. So that we are going to add because it's money that came in. Then we go back, look at trade payables. We have trade payables here. Our balance brought forward was 5,694,624. Our balance carried forward is 4,942,806. What does that mean? It means that we have paid our creditors. That is why the debt, the amount for the creditors is reducing from 5 million to 4 million. Basically, that means that the money has gone out. So it means that this is going to be a decrease in payables. So we have the decrease in payables. Decrease in trade payables. Let me record that down. Trade payables was 5,994,624, then minus 4,942,860. So we have that. So I'll put that as 5,694,624 minus 4,942,860. So into brackets. If you do that, so here you are going to get 751,764. So we less it because money went out. Then the next thing is going to be tax paid. The next thing is going to be tax paid. Tax paid, if you pay tax, it means that money is going out. If you are paying tax, that automatically tells you that money is going out. So if we check on where's that? Okay. Just a minute. So we check on tax paid. Tax paid. Now, when you check on tax paid, we go back to our adjustment. We go back to our adjustments. We add tax payable. We add the balancing figure 867 698. 867 698. That is the figure we are going to use in putting our tax payable. So 867 698. So we come back and indicate the figure as the tax payable to be 867 698. So money is going out with less. So we add. Now we are adding the change in working capital. So so we start by you add, that is 127 that is basically 127 so we start adding this. We get we start by 4,086,654 minus 1,008,592 equal, you get that, plus 12,73,714 minus 751 767 minus 867 698. You get 2 million, sorry, you get 2,732,314. Now this becomes your net cash inflow from operating activities. This becomes your net flow from operating activities. That is 2 million 732,314. Now we move on to cash flow from investing activities. So next is now cash flow from investing activities. Now first in investing activities, we start with the what we call investment income. Investment income. So we have investment income. So we go to investment income. We go back to the question. We were given, as part of the additional, we were given investment income to be 29,484. So 29,484. So we have here 29,484. It means that money came in. The next, we talk about the cash on disposal of machine. Cash on disposal of machine. So money came in our T account. We prepared that, and I say that in disposal of machine, we were given the cost of the asset, we were given the amount of accumulation and the profit. So we assume that the sales proceeds were 398,320. So we have that 398,320. Then of course we have the purchase of non-current assets. So it was purchased, which means that money went out. Purchase of non-current asset. So we go back. Where's that information? Yeah, in we go to our T account, right? We go to our T account. In our T account, we prepared non-current assets, and after looking at the disposal of machine, the balance brought and all that, it means that we got the cash, which means that there was an asset that was purchased at this amount, 4816,240. 4816,240. So because the asset was purchased, it means that the asset came in. That means that money went out. So we are going to less that 4816,240. So we do that. I think those are the only investing activities that we have. So if we add that, that is 29,484 plus 398,320 plus 4816. We less. We have, let me start over again. 29,484 plus 398,320 cosines minus 4816,240. You will get a loss. You will get the loss that was negative 388,436. So you put into brackets. Now this becomes the net cash flow from investing activities. So we go to our third activity that we refer to as now the cash flow. We said in the cash flow there are three. They come from three activities. So cash flow from financing activities. cash flow from financing activities. So cash flow from our financing activities, we are going to start with we have the ordinary share capital, we have the share premium, and we have of course we have repayment of debentures. We have repayment of debentures. That is a loan, that money is coming in, and of course so if we, that is a loan, I mean if we pay, money will be going out, and of course we had financed the cost, financing cost. So financing cost meaning that the interest is being paid, so it means that money is going out. So we'll start with ordinary. Let's start with ordinary, or issue of ordinary shares. So the issue of ordinary shares, we have been given at So what we'll do, we'll get a difference. We'll get the difference. So what we are going to do, we will have to calculate that. That is 10,920 minus 7,800. The difference is 3,120,000. 3,120,000. That is what we are going to take. $3,120,000. Then next we are going to talk cash from issue of premiums. That is cash from issue of premiums. That is shares. That is shares. Share on the premium, share premium. So on share on premium also we take the difference. We do, that is 4,103. So we get this 4,103,840 minus 4,038,814. 4,103 840 minus 4,038 814. You will get 65,026. You will get 65,026. Then of course we have repayment of debentures. We are being told repayment of 12%. Debentures. That if we go back to the question, 12% repayment of debentures. So you see it's decreasing from 2023 to from 4 million to 3 million. So which means that money went out. So what we do, we get 589,000 minus 351,680. You get 1,007,000. So we indicate here the repayment of debentures. We are going to less, so we put it into brackets. 1,087,320. So we less that, and of course the next one is the interest paid. Interest paid. This is from the finance cost. We were told, if you look at the finance cost here, the finance cost is 410,800. So money went out. So what normally we do, of course, we will less that. So that is we less 410 800. So if we add this 120,000 plus 65,026 equal minus 1,087,320 minus 410,800, you will get the net cash flow from financing activities to be 1,686,906. This is what we call net cash flow from financing activities. So that is our cash flow statement. So if you see, we started with the cash flow from operating expense activities. We came all the way to the third one. So in terms of preparation, because I prepared it earlier before I came for the presentation, so there's a very clear format here. We have the cash flow from operating activities, we have the profit before tax, you adjust for the finance cost, the investment income, then you add the investment finance cost, you less the investment income, you less the gain on disposal of machine, you add the depreciation, you will get profit before changes in working capital. Then you calculate the changes in working capital, there is an increase in profit, you get that. So you decrease in trade receivables, you add decrease in trade payables, you less, then you less the tax paid, you will get the net inflow, cash inflow from operating activities. Then you come and calculate the cash from investing activities. We have the investment income, we have the cash on disposal of machine, then we have the purchase on non-current assets. Then you will get the net cash flow from investing activities, which is negative. Then we have the cash flow from financing activities. We started with the issue of ordinary shares, then we came to the cash from issue of share premiums. Then we looked at the amount that was repaid back, because we are being told that repayment of 12% debentures, then the interest paid because there's a finance cost. So once you do that, then you have the net cash flow from the financing activities. Now, how then do you tell that you are financing, or how then do you tell that your cash flow statement is balancing? So what you do, if now you are able to add, let me take you through this. If you are able to add the net cash flow of let's check on this, 2,732,314 minus 4,388,436, you will get that negative, plus 1,686,906, you will get 30,784. That becomes the increase in cash and cash equivalents. Increase in cash and cash equivalent. So how then do we get to know that we are correct? So what happens here, we will come and add this increase in equivalent with cash. If you come back to the question, we add that with cash. Sorry, where is that? Let me check on that. in the bank, cash in bank. So what we do, if we add the increase in cash and cash equivalent, the balance brought forward plus the balance forward, so we got 3784. So if we add that 784, we add to the cash at bank balance brought forward, that is 278 408, you will get 309 192. That means that you will get the cash carried forward. That means that your calculations are correct. So it means that our cash flow statement is correct, because that balances with the cash at bank which was carried forward, so that we refer it as cash and cash equivalent at the end of the period. So that means that our cash flow statement is correct or is balancing. So that is how you prepare your statement of cash flow in that account. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions, and also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.